parte de New Ventures. Me acompaña Alejandra Revueltas, que es nuestra directora de portafolio y que ahorita le toca la no envidiable labor de perseguir y estar apoyando a cada una de las empresas de nuestro portafolio y pues igual que todo el mundo, pues todas las empresas en las que nosotros hemos invertido pues están teniendo algún tipo de complicación y Alejandra hace pues una muy buena labor de tratar de apoyarlos, ¿no? I'll switch it over to English for also those that don't speak Spanish, since now, in difference to the regular FLEA, we don't have simultaneous translation. And we will be talking about revenue-based financing today. Let me share my screen here. There we go. Ale, does that look fine? Okay.
Yeah.
Perfect. So, just a brief, outline for today. We'll go through a couple of slides, just kind of lay out, kind of our thinking around these types of structures, why we use them, where we've invested in them, and some of the benefits and challenges of these structures going forward. And then at the end, Alejandra can kind of moderate questions you might have, and we can address those at the end. Just as a way of just introduction for those who don't know us, Adobe Capital is basically the leading RBF investment platform in Latin America. We've been doing this now for the last 10 years and really investing in both social and environmental companies that are, addressing some of the region's most pressing needs. And just as a bit of a background on what we do and how we do it, we manage currently two funds. Fund 1 is a 2012 vintage. We've invested in 8 companies there. That was a Mexico-only fund. We've had 3 exits, and it's been pretty broad-based within both green and social sectors, including housing, healthcare, SME financing, sustainable consumer products, student loans, mobility, things of that nature. Fund 2 is where we're investing out of right now. Fund 2 is a $30 million vintage, 2017, $30 million fund, 2017 vintage. Here we've made 4 investments, 3 in Mexico, HED that does solar energy projects, IPET, which focuses on physical therapy, Cuepa, which does online bachelor's degrees and high school accreditation. And finally, our first investment out of the 12 we've done to date in Punto Red, which is a financial inclusion platform in Colombia. So now we've branched out as well as we've done in New Ventures and really looking to have a more of a region-wide impact. And to set the kind of the basis for this conversation today, we're in this slide, you can see a bit what an RBF is, right? A revenue-based financing is a relatively new term, and it can be debt, it can be equity, it can be quasi-equity, it can be a mix of either of those two. And I think what really sets it apart is that the repayment is variable, right? And so it adjusts to some type of metric that the company has and that you as an investor track. We like to do revenues because revenues they're easy to track, they're easy to audit. But you can do EBIT, you can do EBITDA, you can do net income. I mean, whatever basis you want. It's just the further down you go on the income statement, the more you have to look into expenses and, are they recurring or not? And, it opens the door for, some, jiggering of the financial statements in order to, minimize the payments made. So we like revenues, but we can be anything like that. And in difference to a typical loan where you have to pay a specific amount of money each month, regardless of what happens, we like this because, if you sell 100 and you're, the royalty is 3% per month, then you pay 3. If you sell 200, you pay 6. And, in current environment we're living in right now, if you have 0 sales, you don't pay anything, right? So it adjusts naturally to the way the companies are progressing and how they're growing. If it's a loan, it can include a conversion into equity, and that's where maybe it has more of a quasi-equity type of um, feature. And also, it can include a board seat or veto rights if it's more on the equity side. So you can, kind of had some control and some, say so in how the company gets, handled. What are the benefits? I think the benefits are twofold. First, for entrepreneurs, the one that the entrepreneurs like the most is there's no upfront dilution. So usually when you're raising equity, you're looking at how much money you want to raise, at what valuation, and that translates into how much dilution the entrepreneurs face. And if you have a lot of rounds, eventually the entrepreneurs might get to a level of equity stake that they don't feel they have, a lot of skin in the game or a lot of upside. The second one, the variable loan repayment, right? As I mentioned, I mean, one example is CPET, this network of universities focused on physical therapy. Universities usually have about 80% of the revenue in 2 months, right? So it's usually January and August. And so during the summer, usually universities don't have much revenues because people are off on summer break. So it's hard to make those loan payments if they're fixed during the summer months. And they usually have to reserve a lot of cash. And that's the reason why banks usually don't lend to universities so readily. So, we did one of these loans there, and it's great because in those months they pay us more, and over the summer they pay us very little. And that's a great benefit for the entrepreneurs. Another benefit can be a grace period. We've done from 3 months to 18 months, and so those are periods when they don't have to pay us anything, so that the money that we give them actually comes in, gets invested, and we actually get paid back off of what that those resources generate going forward. And also, if you have conversion provisions, there's usually no collateral requirements. So usually in Latin America, you have, banks asking for personal guarantees. And so that can be, unappealing to a lot of the shareholders. Also, some of these banks will ask for some type of real asset, right? A house or some type of machinery, as a collateral. And here, we don't do that. We actually lend to the business, and that's, taking business risk and business upside and business downside. And so entrepreneurs like. For us as investors and for our limited partners, we like this because they're usually self-liquidating structures. So, over time, we'll get paid back a percentage of revenues. And then, at the end of the day, we don't have to go out and sell the company to get liquidity. Second, board representation. We like to sit on the board. We like to be active. We like to see what's going on and help, these companies be successful. And this allows for these types of arrangements. Also, the fact that we get a constant repayment of cash flows from the beginning instead of being completely back-ended. And, with conversion provisions, there's still upside potential. So we might have a base rate or a multiple of our money that we're getting paid back. And then if things go well, and the company does get bought out and there is a liquidity event, then we might be able to convert and participate, and that gives us additional upside. And for us particularly, every investor is a bit different. The main three things that we look at when we look at a business is, that first it has a clear path to profitability, right? It's either already profitable or it will be over the period of our grace period that we're giving them, so that we're actually getting paid back from the profits of the company and not from, the equity that's been provided by the shareholders. Secondly, the impact for us is cornerstone for what we do. Impact has to be the core of the business model. It's why they do what they do. It's how they make their money. And that's very important for us. And finally, this tends to be, usually their last round of equity financing. And we'll jump into this in a bit, but, it can get complicated with this type of structure in place for some, new equity holder to come in. and I'll touch upon that in a bit. So that's what an RBF is. I mean, it can be very flexible. We like to think that we do tailored structures. Each of our investments we've made is very different, because every company is different. And I think, it's very different for what a company in education is doing versus something in housing versus something more technologically based or something in finance, or lending. And then also, the situation on the ground in Mexico is very different from Brazil, which is very different from Colombia, which is very different from the Caribbean or Central America. A lot of the larger countries have, a very, dynamic investment ecosystems where, there can be, multiple rounds and there is a lot of M&A. Other smaller countries don't have that, right? So this allows you to come in, invest, the investor, the entrepreneurs to build their business and then pay you back, and then we would leave and they would continue on. So this is kind of what we do and how we done it, and this is what we've been doing the last 10 years. So, diving into more of, the meat of what we wanted to share here is, the benefits of these types of structures. And so right now, when we talk to other investors and when we look at deals where they're mostly looking for equity, the first, point that comes up often is valuation, right? So how much is the company worth, right? Have we, kind of touched bottom, economically in each country, and so is there a basis to now project, what the, quote unquote new normal will look like, or do we have to be more pessimistic, right? And usually with equity, you kind of have to take a bet up front with how much the company is going to be worth. And, you can get around this with convertible notes, but you're really just passing on the valuation issue to, the next investor, and there might not be, much clarity going forward. So what we like here is you don't need to set the value today, because it's very difficult to do. I mean, the analogy that some people use is, try and catch a falling knife. I mean, it's just how pessimistic can you be, or do you have to be to make sure that you're going to be able to, get a good return going forward. And I think that's like the first benefit. The second one is one I mentioned before, which is the structure self-adjusting, right? So, right now we have companies that, just literally are not operating, right? Because their business is more of a retail business. It's not digital. It's maybe mobility. It's customer facing, and for either, government banning reasons where they can't operate, or just their users aren't, they have zero revenues, and that works fine here because then they don't pay us. It's like a grace period. It's a natural grace period. And for those who are maybe or just have revenues at a fraction of what they had originally, that adjusts the same way. And then as things pick up, and revenues start going up, then we get paid more. So we like the self-adjusting mechanism. We think it's fair, and we think that it, shares the risks and the returns between us and our entrepreneurs. The third one would be self-liquidating, right? We talked about this mostly in private equity. Most of the term sheets and most of the investors are looking for a liquidity event. And, a liquidity event is something that allows you to get money from your share. So if you came into a company and you own an X percentage, you eventually want to sell those shares at a profit and get your money back. And that's usually by either selling those shares to a third party, which is hard to do in Latin America, or selling the entire company to a third party, right? Maybe it's a strategic, maybe someone who's a big player in that sector. That's easier to do in the larger countries, maybe Colombia, Brazil, and Mexico. It's really harder to do in smaller countries where there hasn't a lot of M&A. And so this allows us to establish a certain multiple of our money going forward, and then paid back as a percentage of revenues. And when we get to that multiple, we can go our way and the entrepreneur can continue doing the great things they do. third is renegotiable, right? The terms can be renegotiated as again, the new normal sets in, right? So in this new context, do you need to reduce the royalties at the front and then maybe increase them at the back? How does that look like? And finally, the upside potential that I mentioned, right? We always have convertibility provisions under certain rules and times where we can basically convert to equity in the case that there is a sale of a company, right? So we might be able to convert at 6 times EBITDA and the company gets sold at 8 times EBITDA. We convert at 6, we sell at 8, there's an extra there that gives us upside. And so, within the context of the uncertainty that we're living in right now, we believe that, this type of structure presents lots of benefits. I think you need to be flexible. I think you need to be creative. I think you need to, think about, what you want to achieve going forward, what's your holding period, what the entrepreneur is looking for. But, this seems to us that, kind of encompasses the 5 main reasons and benefits of why this would make sense. And on another note, what are the challenges? I mean, it's not that easy, right? The first one, and this is a big concern that we have, is runway. So currently, every one of our entrepreneurs is focusing on preserving cash, and they've had to make the hard decision of laying off people and selling assets. It's something we never like to do, and it's really painful, but it has to be done. And within this context, runway, or the amount of money you have before you run out of cash, usually measured in months, is a key to survival. And so the problem here is that by siphoning off a percentage of revenues every month, you are restricting cash flow and you are reducing the runway. So, you have to look very closely at what that looks like, and there's benefits to that. The benefit is that you didn't have that upfront dilution. The challenge is that, going forward, if maybe those 2-3 months that you siphoned off to pay, one of these structures, might have been the difference between surviving and not. You can include grace periods, or you can renegotiate, as we mentioned earlier, but this is one thing that definitely must be kept in mind. Secondly, dilution. I mean, we mentioned the upfront dilution is you avoid it by these types of structures, but in this case, what we're finding is, if we were to convert, because that's our collateral, we would basically be able to, we would have to dilute some of these entrepreneurs. And that goes into the third point, right? Because this is usually done as a loan. You can do it as a preferred redeemable shares, which would be preferred shares that get bought back, by monthly payments until you get to a certain multiple. But usually they're seen as leverage. And so a lot of people who are now looking at companies where we have the structure might look at this and say, this seems, it seems risky to come in within the current context and have a leveraged financial structure. And so investors are asking us to convert a loan before they inject additional equity, and which we're open to do, but it becomes a double dilution, right? First, the dilution from us converting our note or our convertible loan, and then from that extra equity coming in. So while you do avoid that upfront dilution, eventually it can be higher or similar going forward. Also, when we do these structures, we make a very, detailed analysis for how the company, how we believe the company is going to, perform financially over the next couple, 5-6 years. That's usually our base case off of which we calculate what the royalty payments are. So we don't have a set royalty payment. It's not like, we give you so much money and you're going to pay us 3% of revenues. That's it. They're different in all companies. And sometimes it's they're increasing, sometimes they're fixed. It really has to, track the profitability curve of what we think the company can achieve going forward. And so right now it's hard, right? When is the economy going to recover? How is it going to recover? Are retail customers going to go back? I mean, is it going to be a V-shaped recovery? Is it going to be a U-shaped recovery? Is it going to take 12 months, 18 months? It's hard to do. But I think you can what we've been doing here is we can do a couple of scenarios, right? And say, if things don't pick up, then you're paying me 2% of revenues. But if they do pick up, you're paying me 4% or something like that, which adjusts going forward. And finally, as we said, we don't take real assets as collateral. We're not asking the entrepreneurs and shareholders to act as personal guarantors. We basically have a convertibility provision into our loans where we can convert to equity on the upside. Now, that said, since we don't have collateral, on the downside, we do have equity-like downside risk, right? So we can lose, a large portion of our money. And that's just something that, has to be taken into consideration in the return to risk profile of each investment. So hopefully, this kind of reflects a bit of our thinking around this. As you saw in earlier slides, we've done 12 of these investments already. We've already round tripped 3. We've already done 1 outside of Mexico, and now have a very strong pipeline throughout the region. And so look forward to continue innovating in the space. I think New Ventures and Adobe Capital tried to innovate by coming in early into the impact investment space. And now we're trying to innovate with structures that are a bit different to what you usually see in private equity or venture capital to better reflect the needs and risk return profiles of the types of companies that we invest in. So with that, I'll turn it over to Alejandra.
Thank you, Erik. Thank you for sharing. For all of you on the call, we really wanted to give a bit more time to Q&A because we've seen in the past that we are able to add more value to responding all your questions. So please feel free to post any questions on the chat, either in English or in Spanish, and we will try to address them all. So I've seen now that we already got some questions, so I'm just going to read them out loud. So Carolina asks, do you think RBF should be the go-to model to boost the impact investment ecosystem, or not at all, companies would benefit from it?
So it really depends on what types of risks you're looking to take. And so we don't do these types of structures with companies that are not profitable yet. So we don't do it for startups, and we don't do it for companies doing a seed round or maybe an early A round. And the reason for that is that if the company is not profitable, what you're really doing is paying us with the equity that other investors put in. And we think that's not really well aligned between us and the shareholders. We don't think it's the best use of that money. But there are players out there who have a different viewpoint. There are players out there who do these types of structures with startups, and their thinking is that the same way that a startup, even if it's not profitable, pays their office. It pays, the electricity bill. It pays, utilities. It also should pay for its finance, right? It's kind of like, in a way, it's kind of renting your equity, right? In a more, very high level way of thinking. And so there are players doing that. We don't. We think it's a bit riskier, and we don't think the risk return profile in Latin America is aligned in the sense that, if you are coming with that early, equity type of risk profile, but with our types of loans, you kind of have a more fixed, lower rate return. We think that the risk return profile is not there. So I'd say that I think for companies that are already got into profitability and are, growing that, internally, we think it's a great way of going forward. And it really depends case by case. I mean, we've had companies that we've invested in have been profitable after 3 months of operations. Sala Uno is an example. They're a low-cost eye clinic in Mexico, now the largest in the country, and they were profitable as of month 3. Natural gas operator we also invested in, they were profitable as of month 10. So really depends. If you're thinking of doing 5, 6, 7 rounds of equity, and sometime you will monetize your business model, this is probably not the best fit. But it really depends on each investor where they're getting their money and what types of returns they're looking for.
So the next question from Alfonso is, in what type of sectors would RBF not work and why?
So that's a good question. I've never heard that one before. I think I don't think it's so much in which sectors. I think it can adjust to any sector. I think that's the benefit, right? I mean, so we've done it in education where we mentioned that 80% of revenues come in 2 months, and that's a great fit. Also, we've done it in housing where usually you sell a house, but then you get paid back as you build it out, right? And so we can get paid back as they receive the cash, not as when they book the revenue. I think more than sectors, I think it's for companies that have more of this VC mentality of, I'm not profitable right now. I don't know when I'll become profitable, but in the meantime, I'll just raise my A round, B round, C round. This is not a good fit, and it's not a good fit because just the next round, the equity investors are going to be like, well, what's up with this? I mean, why are they getting paid and us not? And why are you levered? And so I think it's more of that type of vision that the entrepreneur has. But we haven't found any sector where it doesn't fit if you're flexible and creative.
Mm-hmm. And then another question from Luigi, which I think is a bit more technical, says, how do you estimate the royalty? Does the analysis look like a loan based on interest rate, or how does it look?
So no, we do. It's very hard to calculate a royalty and then an interest rate because interest rate depends on time to define the variable. What we do is we define a multiple of our money. So it's usually 2.5 times our money. So we tell entrepreneurs, if I'm going to lend you $1 million, you're going to give me my $1 million back, and then you're going to pay me 1.5 million in quote unquote interest. And so every payment that they make gets them closer to that fixed amount, because at the moment when we've gotten $2.5 million back, then we're done, and the loan is basically paid off. But we do a lot of modeling to make sure that the percentage of revenues that we're charging based off of what we think the company will generate will be able to pay us back in a 4 to 5 year period. So there is a lot of detailed analysis, but that's kind of what we've come up with. But you can also do it based off of IRR. It just gets a little more convoluted.
Okay, and then the next question by Julian says, I'm assuming that you routinely have to explain the RBF structure and maybe convince entrepreneurs of it. Have you seen a change in the reaction from entrepreneurs since the beginning of COVID crisis?
So yeah, I mean, the convincing is a large part of this. I think when we started, 10 years ago, and we were doing the first of these structures, it was hard to convince entrepreneurs that it was something that made sense, and a lot of entrepreneurs just felt that it was kind of this Trojan horse that looked great on the outside, but inside had some perverse, terrible mechanism where we would wait until we could convert, and then we convert and take 80% of their equity is kind of a backhanded way of taking advantage of the situation, which has never been our way of dealing with this. So at the beginning, it took a lot of, conversations and just getting them comfortable with who we are and what were our motivations. Now it's gotten a lot easier because having done a number of these investments, we can tell them, here are 3 names of people that we've invested with. Talk to them directly, and they can tell you what they liked and what they didn't. Now, post-COVID, I think we see two reactions. The first is those that are benefiting from the certain environment. So people who are taking internet to the home, or people who are selling, recycled or refurbished cell phones at a discount. I mean, there are business models that are benefiting, and then others like, more retail business that are really suffering. And so I think the first group are seeing really, really high growth, and they think it's a great time to raise capital without getting diluted, because people are very, very, very pessimistic on valuations. And on the second group, we just advise against it. We probably wouldn't even advance and just say, look, if you're suffering, you need equity, and you're going to have to, bite the bullet and dilute yourself. And so those are the two situations, and they're like exact opposites.
Yeah. And then next question from Juan Pablo is a bit lengthy, but I think very interesting. So when you look at runway or profitability percentages, margins on products and services for a specific business when analyzing an investment, do you have industry or business type benchmarks for what is acceptable? Or do you have a general rule of thumb for your preferred investment profile?
So it's we've done 12 investments in 10 years. This isn't a high volume model. It's really about finding the right entrepreneurs, the right fit, and then taking the time to make sure that it's structured correctly. And I think that we've exited 3, and all the rest of our companies are still up and running because we've done that work very diligently. Now that said, our rule of thumb is usually that a entrepreneur can raise in this type of structure about 1 times trailing 12-month sales, and it should be higher. So just as an example, if a company has $500,000 in sales over the last 12 months, when we've done the numbers, they can raise up to about $500,000 in an RBF structure. Usually you want it to be more like 2 to 1 or 4 to 1, so it's more comfortable. But less than that, it doesn't work. So we see a lot of companies that are selling $500,000 and they want to raise, $3 million. That doesn't work for RBF, and it's more of this VC model of raising, large tickets with convertible notes and trying to grow quickly.
Okay, the next one is related to the challenge of explaining these types of structures to entrepreneurs. From Midori, it says, what is the most difficult concept of RBF to explain for investors, consumers, and people, and why?
So I think it's that it has, first it's very tailored, and secondly, it can kind of be whatever you want it to be. Versus equity, it's kind of like, well, I come in, I give you X amount of money, I have X amount of shares, and maybe some board seat and maybe some investor rights, and that's it. It's a bit simpler. Here is it more equity like? Is it more debt like? Is it does it have a grace period or not? Is it convertible? Isn't it convertible? Does it have a board seat or not? So I think it's more broad based, but that's why we kind of start off when we sit down with entrepreneurs and say, let's start with a blank slate. What are you looking for? I mean, what's like your letter to Santa? What would be your dream type of investment structure here? And we try and work towards that. And each entrepreneur has a different question. I think the biggest one where we have pushback is just how, if we can convert, with what rules, right? And there's always this fear that instead of taking equity now and diluting themselves with giving away 30% of the company, that they take this and eventually we take 80% of the company, and with that's just a lot of work to make them feel that they can feel comfortable with what we're doing and why we're doing it.
Another, I think, technical question as well from Jose from Alphamundi says, based on the metric used to calculate the return of RBF, debt X or X times the amount is worth, how do portfolio companies should account this type of loan in their financial statements?
So it really, that's something that depends. First, if it has convertibility provisions or not. So if the loan does not have any type of convertibility provisions, it's going to be on the liabilities. It's a loan, even if it's RBF, that doesn't matter. If it is convertible, then it's more of a question for the auditors of each company. But we've seen that if it can convert automatically in certain provisions, and usually in our case, it's usually if they make any default on their payments, or if there's a liquidity event, we've seen companies and auditors book it as equity, and that can be a benefit, right, for those not wanting to show a very levered balance sheet.
Next question from Manuel says, when the entrepreneur has valuable intangible assets such as a patent, is it easier for investors to trust the RBF structure, or is it recommended for entrepreneurs to use the RBF structure in these cases? Or is it recommended to search another type of investment structure?
So for us, I think if it has a patent or not, I think goes more towards, the defensibility of their investment or their business model. I think that as investors, we're looking more at the cash flows. I mean, if the patent can be valuable, how do you monetize it? So if they're monetizing it and they have, constant increasing revenues, it works fine. If the patent's going to be more like collateral, it's not something that we would usually look at, because even if you do have collateral, it's very hard to monetize. And usually it's not something that we do. So we're saying, if patent or not, do you have a defensible business model that you can grow going forward, then it's something that we would finance for sure.
Perfect. So another question from Rafael says, given the context, it seems many companies will have difficulties meeting current debt obligations. So can RBF be used for debt restructuring?
Yes. So first, for the companies where we already have the structure, as we mentioned, it kind of adjusts downwards, right? So, if they're selling less, they pay us less. In any case, we granted all of our portfolio companies a 3-month grace period for given the current context with COVID, to just first prioritize cash flows to things that are more essential, and secondly, to share the pain. I mean, if people are being laid off and employees are basically taking pay cuts, we think that we should share in that pain. Now, for companies that now need to refinance, yeah, I mean, this could be definitely a way of going forward. It's a different type of structure, and we would compare it. I think that the biggest question we get there is on, when you've already had a bank loan or some type of credit line, entrepreneurs are they kind of know what their cost of capital is and what it should be, and so what they'll usually ask us is, what's your interest rate? And we'll say, well, it depends. I mean, it's going to depend when you pay us back the last dollar or the last peso. Until then, we're not going to know, but we do have that. And so people who are used to a bank loan at 12%, it seems expensive, but then there's really nothing out there that you can have basically paid back as a percentage of revenues. So there's no benchmark, but we do when people do the math, usually our 2.5x over a 5-year period is an IRR in the low 20s, And so people who have, have a bank loan at, 10 or 12 feel that's very expensive. But that's just a very specific conversation that we have to have with each entrepreneur.
Okay, next question from Alejandro is, have any terms, characteristics of the RBF vehicle have been modified, added, or eliminated since its inception? For example, has the 2.5x multiple been the same, or did this change after taking into account lessons learned?
Yeah, so interestingly enough, 2.5x has kind of basically been where we find that the market is. I mean, I think three seems a bit high, depends on the risk, and then 2.2 times our money is kind of our cost of capital. So we want some upside in that. But 2.5x is kind of what we've stayed with. Things that we've changed are we've done up to 18 months of grace period. We're no longer doing so long because it starts, it makes the royalties after that 18-month period much higher, and it makes it harder for companies to pay that back. Also, what we've done is initially we didn't have any multiple for prepayment below 2, but now we've flexibilized that, understanding that if someone wants to pay us back in year 1 or year 2, 2.5x off of 1 or 2 years is a very, very high interest rate. We don't look at it in IRR terms. We look at it more on multiple term, but that's something we flexibilized. Another thing we've done is now we've included bullet payments at the end. So we'll say, well, let's do a base case that you'll pay us back in maybe 2.5. In 5 years. But eventually, after year 6, then we'll want you to pay us back whatever's remaining, because otherwise it just stays open forever. But other than that, we always look for a seat on the board. We always look to have minority rights on key decisions. A lot of the main backbone has remained pretty constant, but I'd say those are the main changes we've had.
Okay, so next question from Gustavo is, as an entrepreneur, at which stage of my business would I get the most out of a revenue-based structure?
Sure. So I think, if you're profitable, regardless of the size of your sales, or that you can become profitable in the next 12 months, based off of certain metrics that you can achieve with the money you're needing, then it's a fit. Otherwise, if you're still early stage, you're kind of pivoting, you're kind of proving the model, you're still a couple of rounds away from profitability, or profitability is not in your mindset. I mean, we don't think that our way of thinking is a correct in every case. We think that it depends on each company. There's very large, very profitable and successful companies that have never been profitable. We just think that in Latin America, within some of our economies and within the impact space, we think that's a very risky profile, but that's for the entrepreneur to decide. But as soon as you have those characteristics, the advantage is that you don't have to dilute yourself. Usually the companies we're seeing, if they were to raise equity, they'd usually have to give away anywhere between 25 and 50% of their equity, and that can be a lot for some entrepreneurs and not that much for others.
Next question from Benito says, traditionally, impact businesses have been perceived to be more difficult to exit, at least in Latin America. So with that in mind, RBF makes a lot of sense. Does RBF make sense for an industry that usually has easier exits, like mobility, for example?
So I'd say that, exits in general in most emerging markets have been what's really difficult. That's the part of in our viewpoint, and I've been doing this for 15 years in private equity and venture capital and real estate private equity, and now in impact investing. Can you raise money? Yes. Can you find companies where to invest them? Yes. Will those companies grow and be profitable? Yes. It's really the exit And so there's a couple of smaller, bubbles there within fintech and mobility. But you're banking a lot, right? You're banking a lot that someone will eventually come and buy you out. And that historically in Latin America has not played out. There are few examples, but if you grab those examples and you divide them by the total number of investments of all funds, they're very few. I mean, I think if you looked at the top exits of the last 5 years, maybe there are a dozen, maybe there are 2 dozen, but probably not more than that. But just the IDB lab has 350 portfolio companies out of the 40-50 funds that they've invested in. So it's still a small share of that total pool. And so we think it makes sense because it's not that you're not going to look for that exit. You will, but if you find it, this structure works as well as traditional equity. But if you don't, if you don't find that exit, it's a harder proposition. What do you do with your shareholders, right? If they need liquidity. So we think it's probably even more pronounced in the impact space. And you're correct there. I think rural housing is a sector where it's hard to think that there's going to be a big consolidation play out of strategics, or there's going to be an M&A type of structure where you're going to exit. So within the impact space and emerging markets, we think that this type of investment structure has a lot of logic, and should probably be more widely adopted. And it's our hope that by sharing these lessons and our experiences of what's gone well and what hasn't, that this will permeate out into other sectors in other countries.
And I would like to slip in a question there, because I think it's very related to this question and to what you were saying. Do you think these types of structures are more suitable for social enterprises, or would it work for traditional enterprises, or like across different sectors? Because as Benito was saying, we always say that we have to innovate more in order to serve social enterprises. That we, as investors, we need to try to focus on their specific needs, and it doesn't work sort of the same suit for all the companies. So given this, and given that the RBF is a bit more innovative structure, do you think this is more suitable for these types of enterprises, or would it work for all companies that meet the specific characteristics to receive this type of investment?
So we've always been impact investors. I mean, that's why Adobe Capital was created. It's the first part of our analysis. If there isn't a measurable and intentional impact generated within the DNA of the company that we're looking at, we'll pass, because we think that there's less capital looking at those opportunities. And for other more traditional entrepreneurial endeavors, we don't think that they're any less valuable. It's just there's much more money out there for them. And within the impact space, for sure, I think we have to innovate and have to be flexible and different, because for some, there's a reason why there's less capital looking for those investments. And it usually has to be with risk and return, but mostly on the risk side, it's a perception or a non, an unfundamented perception of risk that prevails. Now, there's a big movement in the U.S. at the present day around RBF. There's a working group of like-minded investors, and there's large funds, that are starting to raise $100, $200, $300 million. One of those is Lighter Capital, and Lighter Capital just focuses on VC, endeavors in the U.S., Silicon Valley, and other places, and they have the same viewpoint. It's why dilute yourself if you don't have to. let's do, shorter investment periods. Let's just change the way things are happening. So I think it works for any type of in endeavor. It's really on, what's your motivation as an investor, who's giving you money, and how do you determine success?
Correct. So I think we have time for 2 or 3 more questions before like the final thoughts. So if you would like to post another question, I think we still have time for one more. So next question from Jacob is, considering a 2.5 return over 5 years translates to effective annual interest of over 30% on a traditional bank loan, what are the types of factors that play into those individual conversations with entrepreneurs justifying the much higher cost of capital of RBF?
Yeah, so this is that necessary, conversation around what's the interest rate, right? And so people will make this analysis and say, well, I can get a bank loan at 8 or 10%. Why should I pay you 40? And the first one is, well, if you can get a bank loan at 8 to 10%, go and get it, right? I mean, you have the collateral requirements, and if you're willing to be a guarantor, you can go do it. A lot of the companies that we cater to and work with can't get a loan, right? So that first analysis is a bit moot. Secondly, when we run our numbers and we share them with entrepreneurs, we're looking usually that 2.5x. We'd have to look at how you're calculating it, but usually if it's a grace period and it's a escalating percentage of revenues, that IRR is kind of back-ended, so it's more of a 24, 23%, not 40. I think 40 is the typical loan. And finally, what's the value of not being diluted? What's the value of getting this money now and not having the risk of or of having to pledge your house? One of the criticisms we have towards the banking sector in general in Latin America is they don't lend to companies, they lend to the owners. And so if you have, usually it's pretty ridiculous, but usually in Mexico, if you're looking for $1 million loan, you need to have a real asset at 1.5 times the value. So you need to pledge a house, which is worth $1.5 million. And you and every single shareholder has to be a guarantor to the loan. Most people don't have that profile. Most investors, if I have 10% of a company and I'm a shareholder, I don't feel comfortable, pledging my shares and me personally as a guarantor to the loan. And usually, it's a very different type of attitude than what you see usually in lending and maybe in the US or Europe. So is it more expensive than, traditional bank loan if you can get it? Yes. But then it's not it's not really a apples to apples comparison. There's a lot of things in here factored into the fact that, if things don't play out, since it's variable, and we get paid back over 8 years, suddenly that rate might be, single digit, and it ends up being the lowest cost loan you're ever going to find in your life. So, but otherwise, if things go great and they pay me back in 3 years, maybe I get a 42% IRR. At the end of the day, it's the same amount of money. And so what you're playing with is just a variable, which is a bit synthetic, but a lot of the conversations that we have with entrepreneurs go around this. And for us, we always need to find something that feels fair on both sides. Otherwise, we won't do a deal.
Now I'm gonna go back, so I missed one question from Barbara. It says, given how COVID is affecting the profitability of companies, how should an investor balance seeking a greater return from the added risk while offering manageable and attractive terms to the entrepreneurs, particularly the royalty percentage?
So this one's tough to answer because every company is different, every sector is different. I don't think we've ended up having a full understanding of what the impact's going to be sector by sector in the long term. I mean, there might be companies that aren't really affected right now, but within 12 months they will. And so I think it's just sitting down company by company, projecting out what we think they're going to do, and coming up with a structure that makes sense. But it is really tailored. I mean, there are models. Mentioned lighter capital in the U.S., and they kind of have their defined term sheet, and if you meet, it's a high volume type of model. We're doing something similar with Biwala, which is lower amount loans, which also have a percentage of revenue repayment and a lower multiple, but it's more like shorter term, and so it's a different model, but we're trying to innovate on both spaces, on both, the higher ticket sizes with Adobe Capital and longer terms, and the lower ticket sizes and shorter terms with Viwala.
Perfect. And then the last question from Mariela says, what is the longest repayment period considered, and what happens if the company did not meet its projections and the multiple is not repaid in that period?
So, in some of the earlier deals we did, we just, took that risk. One of our early investments where we already exited, it was just the perfect storm. Everything that could go wrong did go wrong, and it was just, a very complicated situation. And Alejandra helped really to weather the storm and come out on the other side with a pretty good story. But in that case, at the end, we'd been invested 5 or 6 years, and the company was not going to achieve the economies of scale that it thought it would. And so at that point, what basically happened is we came back and negotiated a final payment. We ended recovering about 85% of our money. So it was a loss, but given everything that happened at that company, we think that it was a pretty successful story. And so that happens. And now what we're factoring in is, maybe within year 6 or 7, a bullet payment. So whatever they haven't paid us up to that moment, they have to pay us, lump sum. We're not, how do we enforce that? It's a lot about trusting the entrepreneur, and at that moment we'll have to figure out what to do, right? Can we refinance? Can we, what can we do, right? It's not like, there's a hard pledge of, that says, again, going back to the entrepreneur's house for us to be able to recover that. It's mostly it's a goodwill contractual obligation, and we'll have to work, together to figure that out. But over a long a period of time, a majority of, hopefully, our principal has been repaid, and then we might take a haircut on the return that we're looking for, and at the end of the day, we want this to be a win-win for us and the entrepreneurs. If recovering our money makes the company go bankrupt, from a financial perspective, might be something positive. But us that are really impact investors, if that's going to make the company be unable to continue doing all of the great things that they're doing, then maybe it's not a really positive experience. So I think the difference with an impact investor is that at the end of the day, we want the entrepreneurs to grow, and we want them to continue doing the great things they're doing, and we want to be a transitional investor, and we don't want them to be able to have to sell their companies for us to be able to achieve profitability. So that's kind of our thinking around that.
Perfect. Well, I think you addressed all the questions we had. So thank you very much. I don't know if you have any final thoughts to share with the audience. Otherwise, I will pass it on to Ana.
No, thank you all for taking time. It's hopefully this has been interesting. It's piqued a bit of your your creativity and thinking about things differently. I think that as you move forward in your endeavors, either as investors or entrepreneurs, what we invite you is to think creatively. I mean, think out of the box, try and find other ways of doing things. I mean, just the traditional ways of financing companies are traditional just because they've been done that way for a long time, not that they have a particular logic. And a lot of the mindset for investing has come from Silicon Valley, which is probably the entrepreneurial ecosystem most far away in terms of focus and dimension from most of Latin America. So that to us is not a good starting point when we think about what we want to do and how we want to achieve it.
Thank you, Erik, and thank you, Ale, and all of the participants. I'd love to get a quick picture, so if you can help us enable your video, we'd love to just get a quick picture of you and then finish this session. I see some familiar faces. Hi, everyone. Okay, just give a couple of seconds. Perfect. So Ana Garcia, I don't know. I'm terrible with technology, ironically.
There are more pages. This is the first page, so you actually, if you go right, there's more.
Oh, wow. Yes, we have a full house here. So maybe we have to do a couple of screenshots. I don't know, Ana Garcia, if you can help us with that.
Yeah, yeah.
Figure out how
there are actually 4 slides, so I'm starting here with the first one, so say cheese.
Thank you so much, Erik. That was super interesting.
1. Here I go with
We'll
the
see
second
you. We'll
one.
see you around for the happy hour.
Oh, the baby. Hello, baby. And in the third one, actually, there are no webcams on.
Okay. Well, thank you, everybody, for tuning in. Thank you, Erik. Thank you, Ale. Hi to Itziar's baby. Bye.
Bye.